The futures this morning after one of the worst days in the S&P we've seen in a while yesterday. Joining us now is Mona Mahajan, head of investment strategy at Edward Jones. At least for yesterday, some of the chickens came home to roost. Do chickens roost or just roosters? I don't know. Tom Lee earlier in the week, I think on Monday, said bullish for November, but going to be tough near term, and it happened yesterday. And it was all really based on valuation of AI and tech.
Yeah, you know, it's interesting. We are certainly seeing a little bit of a dichotomy between what's happening with the technicals in the markets versus the fundamentals. So technical picture, of course, S&P is up 35% since the April lows. That NASDAQ is up closer to 55%. So narrow leadership, we know coming into this. We're starting to see signs of technical weakening. Percent of S&P companies above their 50-day moving average is deteriorating. And of course, we have the example of a company like Palantir yesterday. They reported strong earnings and guidance, but of course, the stock sold off due to valuation concerns. So could we be due?
Valuation concerns, is it just a turn in investor sentiment? What's okay today or what was okay yesterday isn't okay tomorrow type of thing?
Yeah, it does feel like there was a line in the sand that was crossed, and now folks are saying, let's sell the news, let's take some profits here. But the fundamentals of AI this earnings season, we think, did come through. We saw not only these companies reiterate their guidance, but also reiterate their CapEx spending for next year. So clearly enthusiasm for the sector and the outlook going forward. But we think, could the market pause, take some profits? Absolutely.
I saw a statistic somewhere, I think maybe Ed Yardeni or somebody put it out. Information technology makes up 45% of the market cap right now. But it's 38% of the profits, too.
Yeah.
So it's not an outsized valuation when you look at the amount of profit they are generating.
Absolutely. And I think certainly earnings growth this year, I mean, 10% in the S&P, over 50% is driven by that technology sector alone. So they are driving a lot of the fundamental value.
Yeah, but you point out that some of the best results we've seen and even some good stock market performance, not in tech, like other areas.
So we do think if you're looking in the year ahead, so next year's S&P 500 earnings, 13% is the forecast, but that is actually driven by both tech and non-tech parts of the market. So we think about the fundamentals next year, probably a Fed that's cutting interest rates, a tax bill that's kicking in to support CapEx and R&D spending, and earnings growth that's coming from tech and non-tech parts of the market. This is a good environment for some cyclical catch-up, we think. And so if you're looking to put new money to work, or if you're looking to rebalance or diversify, it is interesting to think about those parts of the market that maybe have some scope for valuation expansion and some catch-up.
So you think that there's going to continue to be valuation problems with the prior leadership, or because a lot of times stocks that have been hitting new highs, they back off, then they hit more new highs. You don't think it's time to go into the AI stocks, the tech stocks? If you get a decent pullback, let's say we get another 5%.
Yeah.
Would that attract you back in?
You know, I do think so. Valuation is never a good near-term indicator of what's going to happen. You know, high valuations could get even higher in the near term. But I do think what is a good driver of momentum is what's happening with earnings. So we are, you know, we like both growth and value parts of the market. Overweight areas like industrials and healthcare alongside, you know, AI and technology. So it's really a story of market leadership broadening, but including, you know, AI is a secular theme here. It's got 3 to 5 years probably of momentum behind it still. And so we think there's no reason to kind of bow out early. We want to make sure we have that exposure. Is
there anything fundamentally that is on your radar screen that could be a problem for the markets? How about this tariff that starts today? They don't even know. They wouldn't even know how to refund tariffs if it's never been done before.
That's going to be tricky. We think the administration is keen on making sure its tariff policy is implemented in one form or another. You know, the other fundamental things we think about, of course, are things like the labor market. We get some data today as well. Of course, it's not the A+ data that we're used to with the non-farm jobs report. But metrics and indicators are showing some softening here, lower supply, lower demand of labor. And of course, you know, the ongoing government shutdown does put pressure on the economy, albeit we tend to see that rebound once the government reopens. But nonetheless, as the Fed is looking at a December meeting, we could be in the midst of that softer economic data, maybe some softening in the labor market. But we think 2026 is gearing up to be a rebound year.
You could almost say that the government shutdown is probably bullish for stocks because it means the Fed is on track to do, maybe if anyone was doubting after Jay Powell's sort of pseudo-hawkish comments afterwards. This would put him back in the dovish camp.
Agree. It's a factor
Awesome.
that's going to drive them
Okay,
to move.